Hello, everybody. As you can see, I'm not exactly in the business attire today, and it has been a couple of days since I had a shave. But I'm vacationing. I'm in the Christensen vacation home in southern Sweden, in Skåne, as we say, enjoying the rather cold Scandinavian summer weather with the family. But I thought I just had a little bit of time now this afternoon or this night to share with you rather an answer to a question I got today about demographics and inflation, or rather deflation. What we often hear when we hear commentators, analysts, and so forth in the popular and in the financial media, it's argued that there is a relationship between negative demographics, declining population, declining labor force, and deflation. That negative demographics, so to speak, causes deflation. What we most, of course, hear is the story of Japan, 2-3 decades of negative demographics, declining population growth, declining labor force growth, and a period of low inflation and even deflation, and also a period of very low interest rates. In terms of that, it's notable that it's not given that negative demographics should cause deflation. After all, inflation as well as deflation is a monetary phenomenon. It's not a real phenomenon, it's a monetary phenomenon. So why do we get deflation when we have negative demographics? Well, it's not given we will get that. In fact, if you look at a traditional way of thinking about this, then negative population growth is a negative supply shock. And normally, we would think of a negative supply shock as something that push up the price level, and continuous negative supply level causes higher inflation. So that is the traditional ASAD curve, where the AS curve shifts to the left and push up inflation or push up the price level. So why could we have a situation where the opposite is happening, where negative demographic shock, negative supply shock, causes deflation? Well, the reason for this is that we have to take into account the way monetary policy is conducted. If we think of the way that the Bank of Japan has conducted monetary policy over the past 3 decades, Japan have had a floating exchange rate. Japan didn't used to have an inflation target. In fact, it never really stipulated before Kuroda became governor of the Bank of Japan a couple of years ago what target it had. But it did target interest rates. It was keeping interest rates at a given level. And as many central banks, the Bank of Japan, or most central banks with floating exchange rates, the Bank of Japan used interest rates as its primary instrument. However, the interest rate is not really the instrument. The instrument is the creation of money, is the money-based control. Interest rates, intermediate target that central banks like to use to hit a final target, for example, inflation. However, if you're in a situation where you use the interest rates as the instrument, the task of the central banks becomes to set the short-term interest rate in the market by controlling the money base in such a way that it's close to what we call the natural interest rates in the tradition of Knut Wicksell. After all, I'm in Sweden right now. Knut Wicksell talked about the natural interest rates at the interest rate level that would ensure balance between savings and investments and full capacity of the economy. Of course, with later in new Keynesian economics, think of the very similar thing in models of Woodford. So the central bank sets the interest rate levels in accordance with hitting the natural interest rate. However, there's nothing, contrary to what it looks like in new Keynesian models, that says that the natural interest rate is constant over time. It changes, and we know from growth theory that if trend growth is slower, the natural interest rate should be lower. And this is also what we see across countries. There's a fairly clear correlation. Countries with higher trend growth tend to have higher real interest rates, and countries with lower trend growth tend to have lower real interest rates. And of course, you could just say among the the developed economies looks at Australia and New Zealand, countries with fairly high population growth and therefore high trend growth. They have high real interest rates and have been having high real interest rates for the last couple of decades, while Japan, with low population growth and therefore low trend growth, have low real interest rates. So what happens is that when the population starts to decline, population growth becomes negative, labor force growth becomes negative, real trend growth becomes lower, and therefore the natural interest rate should be lower. That is no problem if interest rates is at 5% and the natural interest rate then declines to 3%, then the central bank just adjusts the money base in such a way that short-term money market rates drop to 3%. Nothing bad happens from that, and as long as there is credibility about the inflation target, inflation will stay on target. However, imagine you're in a situation where you're already down to 1% in interest rates, or maybe even 0, and you get negative demographic shocks. In a situation where the real interest rate should be negative. And many estimates, for example, for the US indicate that that's actually the case, that real interest rates in the US now should be negative. And if that's the case, you should have very, very low interest rates. And it might be necessary to push nominal interest rates below 0 as well, particularly if you have been hit by negative shock. So negative demographics will tend to push you very close to the 0 lower bound or even lower than the 0 lower bound. And if you're, as a central bank, unwilling to print money instead of using the interest rates as your instrument, then you get automatically a deflationary situation. And as that happens, the credibility of your inflation target will gradually be eroded. And this is, of course, what we're seeing, has been seeing since 2008, that the credibility of inflation targets have been eroded both in the US, in Europe, and in Japan. And so with negative demographics, you're testing the 0 lower bound. The answer to this is twofold. First of all, the central bank needs to change its operational framework. It shouldn't target interest rates, rather it should be open about the fact that it's using the money-based money creation, after all that's what central banks are doing, to control inflation and nominal spending in the economy. By doing that, there is no 0 lower bound, and then automatically the real interest rates will just be set by the market. There wouldn't be a problem. So to speak, the real interest rate and the natural real interest rate would always be the same if the target was credible of the central bank and the central bank used the money base to control inflation and nominal spending. Furthermore, if the central bank, instead of having an inflation target, had a nominal spending target or a nominal GDP target, then inflation would become endogenous. If real GDP trend growth were to decline because of negative demographics, automatically given a 4 or 5% nominal GDP growth, inflation will just increase by the same amount as the drop in the real GDP trend growth, and nominal demand will be unchanged, and hence nominal interest rates would also be unchanged, making it less likely that you would hit the 0 lower bound. So when people are talking about negative demographics being deflationary, they are implicitly assuming that central banks will only use the interest rates as their primary instrument, and they are assuming that the central bank is willing to allow the erosion of the inflation target. However, if we assume that central banks can use money creation, after all that's pretty easy, just print some money, and if we assume that it could target nominal spending instead, then negative demographics will under no circumstances lead to a deflationary scenario. So the question is it demographics or is it monetary policy which determines inflation/deflation? Obviously, it is, as Milton Friedman said, inflation and deflation is always an area monetary phenomenon. If the central bank fails to hit its inflation target, it is because the central bank has failed and not because of negative demographics. And it's beginning to rain here. So I better say good night and see you soon.